My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to help make a little money. My job is not just to entertain, but to educate, teach, explain days like today. So call me, 1-800-743-CBC. Tweet me at Jim Cramer. Declaring victory while you're still playing is a dangerous game. Unless you're President Trump. Today felt a lot like a declared victory. Dow gaining 598 points, S&P jumping 1.76%, and the NASDAQ pulling 2.27%. The victory I'm talking about is a nonstop commitment by companies to building things here. Things that otherwise wouldn't be built here. You got to admit that. It's pretty amazing. An amazing list of companies, a lot of jobs in their wake. January, Stargate, joint venture Oracle, Japanese companies SoftBank, MGX from the UAE, and OpenAI committed to $500 billion data center build out here. I know some of that's already in the works. In February, Apple committed to $500 billion in projects over the next 4 years, aiming to create 20,000 jobs. In March, Taiwan Semi committed to an additional $100 billion on top of previous pledges of $65 billion to build highly advanced semiconductor fabs here. Not in Taiwan. The UAE just announced a $1.4 trillion investment commitment to be building here over the next 10 years. That's, by the way, the biggest foreign investment commitment ever. And now Hyundai Motor Group has announced a $20 billion investment commitment, including a $5.8 billion steel mill in Louisiana. Those are wins. Big wins. There's also now a paradigm that companies can follow if they want to have access to our markets. They just got to play ball with Trump. And with our country, after years of getting a free ride, well, I'm not taking much of our product at all. I expect all Korean and Japanese car companies to commit like Hyundai if they want to avoid the worst of the tariffs. They'd be foolish not to. I don't think the Germans will be any different. They've built in Mexico endlessly. Now they have to build here, or they likely won't have access to our markets. You can call it extortion. I don't know. There's no doubt it's working, though. There could be wins in shipbuilding, too. That would be something. They destroyed our industry. Foreign companies did that ages ago. And if you want to sell into Walmart or Costco, maybe you have to pay the piper, too. And if he's lucky, Trump will get China to build here in return for, well, nothing. Because they know that he has a vicious temper if you don't play ball, and it isn't worth fight the guy. How certain am I of this? Look, the stock market is pretty unfailing in its understanding of Trump ever since we realized that he's determined to bring back domestic manufacturing via tariffs, and that's job one. The new jobs aren't the same, I know, but they're tribute. And now that we're getting these announcements, he's suddenly willing to be more targeted with his tariffs. Declaring victory. Now, why is this happening right now? First, we're on the verge of the April 2nd tariff deadline. I think there's a lot of companies, foreign companies, that line up one by one to show that they want to keep our markets open. To make that happen, they know they got to pay up. Hey, pay up. Second, Trump's been listening. Now, he's seen executive after executive from American companies, and he's asked them what he can do to help their businesses do better. He doesn't want to harm U.S. companies that hire here and expand here. He does want to harm those that don't. I'm told the behind-the-scenes meetings with the president are convivial and substantive. Executives who I thought would be lambasted for asking for special treatment are instead finding a president who's complimentary and constructive and wants them to do well, which they all say is, to a person, is a better deal than they got from the previous president. For example, NVIDIA CEO Jensen Huang had some very good things to say about his meeting with Trump. They didn't make this stuff up. Listen to this.
Frankly, he was terrific. He was straightforward, direct, remembered our conversation, really engaging. I thought super charismatic. I really enjoyed the meeting.
You really enjoyed the meeting. Finally, there's what happened 2 weeks ago, 2 Thursdays ago, more accurately, when the stock market officially went into correction mode. Sell. Until the market broke down like that, I think the president was perfectly willing to hammer anybody just to get his way. But the attitude out of Washington hasn't been the same since we went into correction mode. I sense a moment where things are going the president's way, and he wants to be magnanimous to those who are doing what he perceives to be the right thing. I know that Treasury Secretary Bessent, well, he hasn't really gotten on board with this view. He seems to be all about indiscriminate pain.
The House of Pain.
It doesn't seem to bother him at all if the stock market gets blasted. He knows from his 35 years in the investing business, the stocks do go up and down. I get that. I don't think President Trump feels that way, though. I don't think he wants to punish good American companies that make things here. That seems like a new development. Now, it's entirely possible that since the market has bounced back, we're going to hear once again about protectionist tariffs, the kind that President McKinley favored. We've talked about President McKinley before on the show. It seems like President Trump's people do favor him. Now, consider those kinds of McKinley tariffs as blunderbusses, the kinds of guns that hit everything. When the president speaks to business people, they always stress that protectionist tariffs are too heavy, too broad. They favor the use of more accurate weapons like reciprocal tariffs, the kind that won't hurt American companies unless they've worked hard to get out of the United States. I think that what happened here is that when the market hit that correction level, the president may have heard the entreaties by many of us that the stocks of good companies are getting blasted. He seemingly didn't think that those companies should see their stocks get crushed. I share that view. Now, let's understand each other. First, I can't be sure that Trump has changed, but I do believe that he's never lost sight of the markets and he watches the business channels. Second, none of this is political. It's just clear-eyed assessment of what the president's trying to do. He wants more domestic jobs and domestic manufacturing if it comes to the expense of cheap stuff from overseas. Hallelujah. Third, if companies like Apple commit here, then why wouldn't Trump favor those companies and help them? Why should he insist that Apple pay a high tariff on the parts of phones or phones they bring in after committing such a huge amount of money here to our country? Finally, none of this has to do with Mexico and Canada, where it's entirely possible that companies could get hurt. It's hard to tell because no one involved in the Mexican chain of imports seems to know what to do. I know that Mark Carney, new Canadian prime minister, will elect. He's got a snap election coming up. Isn't going to play ball with an election coming up. No. Therefore, lumber's in play, and I think the rally in the home builders has some danger to it, especially after KB Homes reported just a soda number tonight. I think the reciprocity, I've not heard a lot of reciprocity between the United States and Canada. They're very unhappy with that 51st state rhetoric. I can't blame them. Hey, I bought Carney's book this weekend. It's kind of hard, but that's okay. He's got a lot of them. I like this one. But what really matters is that there's a course of action that will allow foreign countries or even individual foreign companies to ameliorate tariffs. It's a path. And once you get a path, you get possible transparency and certainty. And that's what stock markets like. That's what this stock market likes. It's why I can keep rallying as long as the McKinley tariffs are gone and the much more reasonable reciprocal tariffs are in. Of course, if you're a diehard free trader, you're probably still appalled by all this and everything I talk about. But I point out that free traders have been calling the darn shots ever since World War II, even though the game plan stopped working decades ago. Here's the bottom line. At the end of the day, America is the only country on earth that's played fair on trade. Everybody else breaks the rules to protect their domestic businesses. That's hollowed out our industrial heartland, and that dynamic can only change if our government takes a more carrot and stick approach. Assuming Trump doesn't go overboard, that might just be what we've got, and it means stocks can finally stage a real rally again. Big. Michael in Indiana. Michael.
Booyah, Jimmy C.
Oh, man, what's up?
Hey, second-time caller, very happy club member.
Thank you. What's going on with you, man?
I'm doing great after this great day. Let me just say, though, with all the daily texts, monthly and morning meetings that you give, and your Sunday column, which I thoroughly enjoy, how can I be getting all of this for only $1 a day?
Well, it beats the heck out of me, but I didn't determine that pricing, and if I had, it wouldn't be what it is, but that's okay, because you see, I'm a puppet. Go ahead.
Jim, I bought this.
I like the truth. You know, the truth at my age, the truth has a resonance to it. It's kind of dynamite. Go ahead, I'm sorry.
Don't ever retire.
Well, you know, if I'm a puppet, go ahead.
Hey, I bought this stock at $116, and I've been taking a beating on it ever since. I've wanted to cry like a baby, but I'm a grown man, so I haven't. But it's got a PE of less than 14, and it pays a dividend over 3. My stock is Merck. Should I buy more?
Merck is, you know what, Rob Davis does a good job. Merck is all hung up on the fact that Keytruda is the only real big drug they have. Look, I'm going to say something that could get me in trouble, but I like Merck at this level. I really do. But I've got to tell you, and Michael, you know, I play it straight. I like Bristol Myers a lot more. BMY. I like it a lot more because that schizophrenia drug is on the come. I need to go to Ira in Florida. Ira.
Hi, Jim. Ira in Florida. Jimmy, I bought Goldman Sachs about a year ago, and the stock's up quite a bit. Do I sell it and take the profits? Do I do nothing?
Goldman Sachs, sell. I want you to buy more Goldman Sachs. We're about to have a wave of mergers you wouldn't believe and a new wave of IPOs, and people don't seem to realize it. I seem to be the only person who realizes it. You want to buy more Goldman right now, like the club. I'm going to my old state of my old home state. Sam in Pennsylvania. Sam.
Jim, how are you?
Sam, I am fantastic. How about you?
I'm good. Jim, one company that we could be looking at a turnaround story here is Intel. They just got a new CEO, but what is interesting about the company being a U.S. domiciled chip maker, the company's outperformed NVIDIA and Taiwan Semi in the last 6 months, and I think this could be an interesting turnaround story with the fact that they have 70% of their chip foundry business takes place within the U.S., so we don't have to worry about tariffs here.
All right, Sam, listen good, okay? Lip-Bhutan is real. Now, he can't turn it around instantly because the balance sheet's not good. But my money is indeed on Intel. Hey, by the way, AMD's starting to get a couple contracts there. But Lip-Bhutan is an amazing man. He's an incredible CEO, and he will do incredible things. And those who know me know that I have been quick to criticize Intel CEOs who I didn't think were up to it. This man is up to it. Call me a liar. If our government treats tariffs more like a carrot and stick situation, that might be finally enough for stocks to keep the rally going. Remember, I am not a free trader, okay? So I like what I'm seeing. On Mad Money tonight, I'm kicking off a series on stocks that have been shining despite the recent slowdown. You'll like what I have to say about a golden opportunity. Don't miss my reveal of what could be, let's say, my second favorite stock in the group. Then, should you be subscribing to some consumer plays in this environment? I'm going off the charts to find out. I got a couple of good ones. And later, I'm breaking down Boeing's recent rally if I think the stock could keep gaining altitude. I want you to stay with the stock market, and I want you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Today we got a huge reprieve thanks to noises out of the White House that the upcoming tariffs may be more targeted than expected. But we're still in a tricky moment as we wait for the tariffs to go into effect next week. Even though the averages have been rebounding because the president said he'd make the tariffs reciprocal rather than more punitive protectionist version, there's still way too much uncertainty to declare that the sell-off truly is over. Sell. So while we catch our breath this week, I want to spend some time talking about what's actually working in this market. The stocks that are thriving have come down big from their February highs. After today's excellent gains, almost exactly half of the stocks, the S&P 500, 249 out of 500, are still in positive territory for the year, which is much better than you might expect. In fact, more than 90 stocks are up over 10% for 2025. They're just not as visible. I think these winners can tell us a great deal about what's worth owning, even if things got really ugly going forward. That's why all week I'll be going through the 10 biggest gainers in the S&P 500 year to date. Of course, not all of the 10 best performers are worth highlighting. Some of these are simply stocks that were beaten down badly last year and due for a bounce, like CVS and Supermicro, which are up 51% and 37% for the year, respectively. CVS is benefiting from the fact that their chief rival, Walgreens, made a deal to go private, and their managed care business, Aetna, is putting up better numbers. Mainly, though, CVS got too cheap last year, and frankly, after they brought in a new CEO, it finally mounted a comeback. But at the end of the day, this is still a drugstore chain, and I don't like that business. And you know why. It's because of the Amazon Death Star. Supermicro rebounded because it finally managed to file an annual report when these were real questions about whether it could put the numbers together. People were worried the stock might get delisted. But again, Supermicro simply fended off something very bad. It didn't suddenly become good. Then there's Philip Morris International in 7th place, up 26% for the year, because it's consistent tobacco play in an uncertain environment. I have a long-standing policy of just not recommending tobacco stocks, partially for ethical reasons, but mainly because I think that the future of the industry is ultimately very bleak. So which of the year's top gainers are worth your attention? Let's kick off this series with the 7th best performer in the S&P 500, and that's Newmont Corp, formerly known as Newmont Mining, which is up 26% year to date. Newmont's the only gold miner in the S&P 500, but the other gold miners are all doing great, too. We just spoke to Agnico Eagle a couple weeks ago, and that stock's up more than 33% for the year. Barrick Gold's up nearly 22%, one of my old favorite. I like Agnico Eagle more. But let's give Newmont its due for a minute. This company's had a noisy few years with the acquisition of Newcrest Mining. That closed in late 2023, creating the top precious metal mining company in the world. They followed that up with billions of dollars of asset divestitures last year. The new Newmont is still the world's leading gold company by production, although it also produces copper, silver, zinc, and lead with operations spanning the globe. Crucially, in this America First moment, the company is based in Colorado. Last month, Newmont reported a robust quarter, a substantial top and bottom line beat, fueled by stronger than expected gold production. However, their full-year forecast was a little disappointing, at least according to the analysts, which is why the stock sold off in response. Still, after a few weeks down from its highs, the stock heated up again this month, and it's now just below where it was when Newmont reported, because gold prices have been surging. I think this is a cheap stock, selling for less than 14 times this year's earnings estimates, which is a big discount to Agnico Eagle, my favorite again, at nearly 22 times earnings. Although the latter should have much better earnings growth this year, and I think as I've always felt was, all right, let's say it, better run. I'm not the only one who believes the stock's too cheap. Newmont clearly agrees, as they've been a big purchaser of their own shares. If you're looking for a gold miner, this is a good option, even though Agnico Eagle remains my favorite at the moment. But the real takeaway from seeing Newmont on this list of top performers is the fact that the gold complex has once again proven itself to be preferred port and storm for investors when the market gets choppy. Yes, Newmont's on the list of the year's top performers because gold prices have continued to climb aggressively higher. The precious metals now up around 14% for the year, having climbed from just over 2,600 at the end of 2024 to above 3,000 now after breaking through that milestone level earlier in March. Even better, gold's up nearly 50% in roughly 15 months, having entered 2024 not far above the 2,000 level. I mean, this thing has just been on fire. Now, listen, we've heard a lot of talk about Bitcoin becoming the modern store of value these past few years. Everyone talks about crypto as a digital equivalent to gold, but it's clear they play different roles in your portfolio. I've got nothing against crypto. I own a lot of it myself. But during this rocky period over the past month and a half, we found out that when people get fearful, they still want real gold. Meanwhile, Bitcoin's been trading like the NASDAQ composite. Despite the arrival of the very pro-crypto Trump administration, Bitcoin's off about 6% for the year. And on these crazy days that we've had too often in 2025, where tech's leading a broader market sell-off, you tend to see Bitcoin going lower too, while gold holds up just fine or even presses higher into all-time high territory. Yet this year has proven to be another example of why I've long advocated for having some gold exposure. If you want to call it a 10% allocation to gold or 5% gold and 5% Bitcoin or just a little gold, you need some exposure as kind of an insurance policy for your portfolio. You can own gold bars purchased at Costco, though it's a huge pain in the neck to us. You got to store the stuff. The relatively low-cost SPDR Gold Shares ETF, the GLD, that's a great option if you want something that directly mirrors the price of the metal. But these gold miners I mentioned tonight have been working incredibly well. Whether you're talking about Newmont, a top 10 performer in the S&P 500 for the year, or one of the others like Agnico Eagle, this group's outperformance in a tricky period shows you exactly why gold remains a great insurance policy for turbulent times, and I really believe in it. Here's the bottom line. Newmont's just the beginning. Tune in tomorrow night and all throughout this week to hear about some of the best performers in the market, the ones that have held up despite the hideous action of the past month and a half, because they're what works if things get ugly again. Mad Money's back after the break.
Coming up, could companies with subscription models hold the key to this market? Cramer is going off the charts to find out. Next.
All right, today was a fantastic day for the bulls. White House indicating that the president's tariffs might be narrower than expected. That allowed the averages to roar. But the one thing we know about this administration is that trade policy can change on a dime. And lots of people are worried about the impact of these trade wars. Consumer confidence already started falling. We're seeing large layoffs in the government sector because of Elon Musk's Doge. While the labor market's been holding up very well, that's definitely something to worry about. And I know that retail sales, many people are worried about. Okay. Now, I never thought we were headed for a recession, but clearly this economy is in worse shape than it was, say, 6 weeks ago. Of course, the one thing we don't have in this environment is any sense of certainty. And when the fundamentals are uncertain, I like to fall back on the technicals. And that's why tonight we're going off the charts with the help of Bob Lang. He's the founder of ExplosiveOptions.net and the author of Know Your Options. Specifically, we're hunting for the kind of consumer-oriented stocks that can still work even in a slowdown. And for that, Lang argues you want companies with terrific subscription-based business models. You know I've liked these all along. I couldn't agree more. Once people get locked to a great service, they almost never cancel it, like Costco, Amazon Prime, Netflix. After viewing the charts, Lang has 3 subscription-based stocks that he likes. And he likes Netflix, he likes Roku, and he likes Spotify. Obviously, Netflix needs no introduction, right? They practically invented the streaming business, and no one else has ever been able to catch up to them. These guys also have a knack for pumping out great content that's popular all over the world. They use a lot of titles, and we've all learned to use titles. So what do we see in the Netflix chart? All right. First, Lang points out that this stock has had a lot of stuff here. An enormous gap up in January after the company reported a phenomenal quarter. Gap, okay? And that is a pretty amazing gap. Then, starting in mid-February, the stock rolled over along with everything else in the group to the point where it completely filled the gap. As Lang sees it, that reset the stock, and Netflix has been rebounding ever since. I like that. He reset it. That's the way to think about it. At this point, it's up more than 9% for the year. Better performance than most tech or tech-adjacent names. Right now, Netflix has the ceiling resistance at $1,000. Okay, there we go. Up less than 30 points from here, but it's been rebounding on strong volume of late, which is always a good sign. Remember, when it comes to the charts, volume is like a polygraph. A move on high volume is generally a move that's telling the truth. If Netflix can break out above $1,000, Lang thinks to go all the way up to $1,250, which we don't even have a space for. Now, looking at the MACD, moving average convergence divergence, this is one of the technicians' favorite lines. This is a powerful momentum indicator that can help catch changes in the stock's trajectory before, and that's the keyword, before they happen. So in other words, you can take action. In the case of Netflix, the MACD recently made a bullish crossover, and you see that right here. Okay, notice that's the, you can see, this is an odd thing, but you can see that I hope you can see it, that it crossed over right there. Where the black line crosses above the red line, and that's among the most reliable positive signs in the business. At the same time, the Chaikin money flow, CMA, which measures buying and selling pressure, is slightly bullish. Okay, that means the big boys, they're not backing away from this one at all. Now, take a look at this chart that highlights the relative strength index, or RSI. That's another momentum indicator. It's just a little clearer here. It started bouncing after hitting oversold territory earlier this month. All right, and you can see these are things that you can see where, boom, oversold. Okay, right now it's still around 50, which is very good, which tells Lang that Netflix has a long way to go in this rally before it gets overbought. That's important because what you're going to see is this is where, well, whatever. Lang also likes the stock been flirting above the 50-day. That's what I like. Okay, that's my key one. In recent sessions, it's above that level, which is very, very positive. Put it all together, and you'd be a buyer of Netflix right here, right now, and so would I. Everything I saw here is just picture perfect of what you want to buy. How about another subscription play? Lang's also a big fan of Roku. That's the streaming service that has the software directly installed in most new televisions in this country. They currently reach more than half of the households with broadband in America. 90 million people use the streaming platform, and they've been able to consistently grow their user base. Plus, lately, they've done a good job of getting their hands on quality content. Of course, when you look at Roku's daily chart, this thing's a roller coaster. It's really hard to make any sense of it. Lang says it's on the more speculative side. I would say it's completely speculative. But from its highs in February to its lows earlier this month, Roku plunged from just under $105 to $66 and change. However, the stock looks like it's put in a bottom about a week ago, right below the 200-day moving average. All right, that matters. Red is 200-day moving average. And it's rebounded all the way to the low 80s, and that's kind of an interesting level. The thing is, Roku just started to rebound. Lang points out that the Chaikin money flow down at the bottom is still pretty darn bearish. See, it's down below that. That's not good at all. Very ugly. The MACD line, though, is currently in the process of making a bullish crossover. Remember, now I like to see the bullish crossover. I don't like the making in the process, but let's go with what Bob says. He says you can expect the black line to cross above the red line very soon. And again, that's a very consistent indicator the stock's got more upside. In today's trading session, Roku crossed through a ceiling of resistance at the 50-day moving average. Now, Lang expects an upside breakout, with the stock only ripping back to the recent highs near 105. If the stock lingers in the current range between 75 and 80, this one might be a good one for you. Okay, it's a good sign. It might be a good option, good one for call options too, if you're really a little bit more into it. Lang's not ready to give you an all clear here, but if Roku does trade sideways for a few weeks, you might want to get ready to pounce. Finally, there's Spotify, long my favorite, the music streaming service with an incredibly sticky business model. They now have more than 263 million global paid subscribers, up from 124 million 5 years ago. Again, nobody wants to get rid of their music service. It represents incredible value given the low monthly price. So how does the daily chart look? Lang notes that Spotify recently tested its 50-day moving average, then rebounded with decent volume. Then the stock's MACD line has already made that crossover that we like so much. See that right there? They're all about to do this. That's one of the most reliable signs of the business. Lang says Spotify is now building a base at a higher level. It started trading sideways, but in this view, that often means the next move will be in the same direction as the previous move, which means it's going higher. Spotify's shaking money flow. Not bad, right? Still positive. In fact, it's been positive since November. Even the big sell-off didn't scare the big money away from Spotify. With the stock's recent rebound, it broke a key downtrend line and rose above its ceiling of resistance on healthy volume. It's fine. Lang sees it, the big institutions are still buying this thing, and he wouldn't be surprised if this $600 stock makes a run at $700. Good story. I remember it was like in the 300s. That's amazing. Now, here's the bottom line. The charts as interpreted by Bob Lang suggest that Netflix and Spotify should work in this tricky environment, and Roku can trade sideways for a few weeks. He'd like that one, too. Now, if I were to do this, I would buy common stock Spotify, I would buy common stock Netflix, and I would buy calls on Roku. That way, I'd cut off my downside. Let's take questions. Let's go to Paul in Ohio. Paul.
Hey, booyah, Mr. Cramer.
Booyah, Chief. What's up?
Hey, thanks for all you and your staff do.
Thank you. Staff is great. Oh, fantastic. Thank you.
Proud club member, and I'll be able to retire early because of your help.
That's what I want to hear, and that's why we do this. That is the purpose of this.
Very good. Hey, I'm calling about a great American company founded in 1956 whose high-quality products and customer service has helped shape the American culinary landscape. What does the future hold for Williams-Sonoma?
Okay, I think the stock got ahead of itself before that quarter last week. I didn't mind the quarter nearly as much as other people did. I think that this is a digital-first company that's doing a lot of things right. I think that Laura Albert is doing a fantastic job, and I would be a buyer of this stock at 18 times earnings, which is really darn cheap. Let's go to Dane in Florida. Dane.
Hello, Mr. Cramer. This is Dane. How are you today?
I am good, Dane. How are you?
Hey, well, thank God it's Monday, Thanks for asking.
There you go. Hadn't thought of that. Go ahead.
Yes, sir. So I wanted to ask you about the self-driving partnership with GM and NVIDIA, especially down here in Florida. We could really use some self-driving cars down here, Yeah, 90% of the people down here got their license in the discount aisle, so.
Yeah. Well, look, let's talk about it. GM sells at 4 times earnings. That's actually a red flag. If the president does get involved heavily with Mexico and Canada and auto parts, they have the most to lose. That said, they've got a big buyback. I think it's a push. I'm not going to recommend it right here until it pulls back a little. There's something very, very worrisome about that 4 times earnings situation. That means that those estimates are going to have to come down, which means that the tariffs are going to be against them. Let's wait and see. I need to go to Trey, our buddy Trey in Texas. Trey.
Jim, it seems like every time I venture into the market without consulting you first, something catastrophic happens.
What can you say?
For example, this past Friday, I had 50 truckloads of coffee beans delivered to my house after executing a futures trade I guess I didn't fully understand. Despite the fact that I'll personally never have to buy a cup again, I do remain bullish on coffee and wanted to see if you think Starbucks will wake my portfolio up.
I like Starbucks right here at 95. I think it's just a total win. I think you buy some. Actually, you should be selling calls on it because all that coffee got traded. But I really, really like Starbucks. It's come down just enough to be able to start buying some Starbucks. If you don't have any, the club already has some. And thank you for the call. All right, the charts as interpreted by Bob Lang suggest that companies with subscription models could work best in the environment. Stocks like Netflix, Spotify, and Roku, I couldn't agree with more. There's much more Mad Money, including my look at the headlines shaping this week's run-up in Boeing. Then do the Bulls or Bears have a better look at the Magnificent Seven road ahead? I'm running through the group now that people are thinking they're going to bounce. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Last week, Boeing rallied more than 10% on top of a 5% rally the week before. And today, it tacked on another 1.6%. The stock's now up almost 25% from its recent lows a couple of weeks ago. This is big, people. Boeing's been a wild trader in recent months. After a long period of turbulence, stock managed to bottom in November. It's clear bottom after new CEO Kelly Ortberg started cleaning up the balance sheet, and Wall Street figured that the Trump administration would reduce the regulatory burden on the aerospace place. They reported a solid quarter in January, and the stock kept rallying. But then the last few weeks happens, and with Boeing unraveled along with the rest of the market, didn't really make sense because these guys have a huge wait list for their planes. But it's hard to bet on a turnaround when the whole stock market's falling apart. Fortunately, Boeing bottomed again a couple weeks ago after reporting solid orders and delivery numbers for February, a clear sign that their core business was stabilizing. That's what we've been looking for. Now, last week was the real catalyst, though, with two big developments that sent the stock into the stratosphere. After years lost in the wilderness, it's looking like Boeing might finally be back. So what happened last week? Well, first on Wednesday, CFO Brian West made an appearance at the Bank of America Global Industrials Conference, where he gave a much more positive assessment of the company's current operations than many were expecting. The first question was posed to West was basically, hey, how are things going? And his answer was that the year's off to a pretty good start. First, West gave a couple of positive production updates with legitimate progress for the troubled 737 program, which is moving closer to being back in production. That's what's really needed. Now, the 787 program is stabilizing at 5 planes per month. West said that Boeing's on track to increase that later this year to 7 per month. But it's the 737 that's the money. That's what people want. That's what the airlines want. Crucially, there have been no major setbacks to report. Very unusual for Boeing. Sorry. Big change from the recent history, though. West then ticked through some more topics, offering additional bits of good news. Boeing's long-suffering defense business is, quote, starting to see signs of stabilization. The services business is, quote, continuing to perform very well. West also teased that deliveries for BCA, that's Boeing's commercial business, could be a bit better than expected. And in what might be the most positive part of the whole presentation, West said Boeing's, quote, seeing less working capital drag, which could result in hundreds of millions of dollars worth of cash flow improvement. Remember, this is a company that just had to raise over $20 billion from equity sales because it was burning so much cash. And when management issued its full-year forecast for 2025 in January, it was still guiding for a, quote, to be a use of cash year, meaning negative cash flow. But now it sounds like the cash flow picture is better than it was even 2 months ago. Boy, that's a major development. It's very small compression period of time, too. On top of that, West explained that tariffs won't be a big headwind for Boeing because 80% of their commercial supply chain and 90% of the defense supply chain is based in the United States. They source everything they can domestically so that they can throw business to crucial congressional districts. For these guys, buying Congress is more important than keeping costs low. Well, you know, they got to influence the situation there. West also touted Boeing's enormous $500 billion backlog as a structural advantage on the tariff front because the company can say prioritize an order for a domestic airline, deprioritize an order for an international airline where tariffs might apply. Put it all together and you can understand why the stock rallied nearly 7% on Wednesday. The second big positive surprise for Boeing came on Friday when President Trump and Secretary of Defense Pete Hegseth announced that Boeing's defense business had been awarded the contract to build the U.S. Air Force's next-generation fighter jet, dubbed the F-47. This program will replace Lockheed Martin's insanely over-budget F-22 Raptor program, and it might be worth more than $20 billion to Boeing over the course of its lifetime, maybe more. This was a significant upset, people. Lockheed also oversees the F-35, which is currently our most advanced fighter jet program. While that program's been marred by delays and cost overruns, Lockheed was still seen as the technology leader when it comes to these advanced fighter jets. Boeing, meanwhile, has held all sorts of setbacks for its defense program, including delays and cost overruns for the new Air Force One, something that's drawn President Trump's ire. Nobody is betting on Boeing winning the F-47. But then the Trump administration surprised us last Friday. While it'll be years in the future before we see the impact of this contract, one analyst from Jefferies estimated it could be worth 25 cents of earnings per share down the road, assuming Boeing trades at 20 times earnings. That's $5 for the share price. Stock actually rallied more than $5 on Friday alone, largely because this was an incredible endorsement of Boeing's beaten down defense business. Put it all together, and for the first time in ages, Boeing's delivering consecutive positive surprises rather than new problems for the bulls to chew on. Listen, I think it's still early in the Boeing turnaround effort. I'd love to see a quarter, maybe two, of stronger results rather than some vague comments about improving production from the CFO at an industry conference, although that was meaningful. And I think you'd be foolish to assume that no setbacks for Boeing going forward, even if you believe that business can gradually get back to where it was just a decade ago. But having said all of that, it is tough not to be encouraged by last week's news flow. Under new leadership, Boeing feels like it's getting its act together. I've never been willing to totally give up on this one, largely because there are only two companies on Earth that can produce large commercial aircraft at scale. If Boeing had more competition, it would have been a goner. But there are simply too many airlines that need planes and not enough companies that know how to make them. So what happens if Boeing can add some basic execution to the mix? Well, then I bet the stock can keep rallying. Sure, it's already had a nice pop off its lows for the past couple of weeks, but if Boeing simply stays on track with its plans to ramp production while the defense business keeps recovering, that means more upside. Maybe it's because I have a soft spot for great American companies, but I sure hope to see more positive headlines coming out of Boeing going forward. Bottom line, if these guys can keep delivering, I don't see any reason why this $180 stock can't get back to the high 200s. Where it peaked in late 2023, and that's not even considering the stock's all-time high of $446 and change, set nearly 6 years ago, now in March of 2019. Mad Money is back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Crazy everybody. Go. You say the stock is headed by buy, sell. So just be clear. I know the course ahead of time. I stand for the graphic. What you plan to sell. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Crazy. I'm going to start with Kurt in Illinois. Kurt.
Booyah, Jimmy C. I got a quick question, Jimmy C. Real quick. I go to sleep. I go to sleep, and everything's in the green. By the time I wake up, everything's in the red. I feel like Dorothy and the Wizard of Oz and Toto. Hey, Toto, we're not in Kansas anymore. What do you think? And what do you think about HCA?
Okay, HCA, I think, has been punished enough. It's time to buy, and I do think that your depiction of what happens every day is absolutely right. And I feel it's not manipulation, but it's a pain in the butt. Let's go to Sujan. I'm sorry if I pronounced that wrong. In Oklahoma, Sujan.
Hi, Jim. How are you?
How are you? I'm doing well.
Yeah, I'm doing good. Yeah, thank you for receiving my call. Yeah, your advice has been helping me a lot.
Okay.
So, my question is about Western Digital. What do you think about it?
Western Digital is it's just too commodity for me. I can't get behind it. I'm very sorry. Let's go to Shelley in West Virginia. Shelley.
Hey, Jim. I love watching you every day at 9 a.m. and 6 p.m. Eastern Time. That's my favorite time of the day.
Thank you.
I'm a long-term investor in AMD, but it doesn't seem to be doing much lately, maybe a little bit today. My question is AMD a buy, sell, or a hold?
No, look, AMD is getting some business from, I understand it, they're getting some business from Jack Ma in China. The stock is not expensive. I don't mind you buying it. I do prefer NVIDIA, though. Let's go to Paul in Michigan. Paul.
Booyah from Michigan, Jim.
All right, man. What's happening?
I want your opinion on Titan American Cement.
No, I'll tell you. Cement is really one of the ultimate commodities. I can't go there. I'm very sorry. Let's go to Rob in California. Rob.
Booyah, Jim. Rob from California. Thanks for taking my call.
Okay. All right.
I want to see if I should be backing that truck into Nibius.
No, I saw the Nibius booth. I was at the Nibius booth at the GTC festival, but I have to tell you, I'm not recommending stocks that are losing fortunes, and Nibius is losing fortunes. Let's go to Zach in Indiana. Zach.
Booyah, Jim. This is Zach from Indiana, but my good friends call me Moose.
All right, Moose. What's happening?
Hey, listen, Jim. Hey, I'm a long-time viewer, first-time caller. I want your take on Aspen Aerogels for the...
Moose has stumped me. Hey, Bullwinkle, I don't know that name. I'm going to have to come up with I'm going to have to do a little work. Moose, I'm going to dump that one on Ben, right on his head. Boom. Aspen Aerogels. Well, there you go. I'm wearing soft gels, but those are more of kind of orthotics. Let's go to Jeff in Wisconsin. Jeff.
Jim, I did not stick with Cramer. Now, I live in a van down by the river. Jim, my van is too small. I need a Winnebago. When do I cover my short on WGO?
No, I'm a Thor guy, and I'm not, no, we're not going to be, that is the wrong, it's not that point in the cycle. It's the wrong point in the cycle. Because you need about 72 rate cuts for some of these. Let's go to Brian in New York. Brian.
Jim, if MP Materials they're able to actually create the physical magnets that are going to go into the robots. And
I know.
EVs.
I've been recommending this stock forever, and it's finally happening. So I'm going to just say, you know what? Let's stick with it. I am not going to say, hey, after all this time, it's time to go. Latinsky's done a good job. He's been sticking with it, and I got to hand it to him. What can I say? He never gave up, and good for him. Let's take one more. Let's go to Stafford in California. Stafford.
Hey, Jim. How you doing?
I'm doing all right. How about you?
I'm okay. Hey, AMR, Alpha Natural Resources.
Oh, my God. Really? Oh, my God. All right, you know what? We're going to look at this thing. It's down 35%. I really have to look at it. It's a twofer. Got to look at them, and we got to look at that the Aerojet General there, the Aerogel. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, is the pessimism surrounding the Magnificent Seven overdone? Cramer sharing where he comes down on the once-loved group. Next.
Everybody knows the Magnificent Seven is not so magnificent anymore. With last week's thrashing of Meta, the one remaining Mag 7 stock that still had a pulse, well, it looked like it was finished. But as I said over and over again, you simply can't count these stocks out. They have too many things going for them to boot them after they've come down a great deal from their highs. We own 6 of them for the Charitable Trust. This group's got special relevance for me. Let me walk them through so you can get the current state of play. Some real damage here. First back, alphabetically speaking, is Alphabet. Less than 19 times earnings with the stock down from 207 to 167. This one seems to have the most problematic situation because it's got a lot to lose in Google search revenue that may not be offset by Gemini, a chatbot. I don't know a soul who uses it. But Alphabet does have YouTube, and YouTube's crushing it, and Google Cloud Services is kicking butt. I'm inclined to use today's strength actually to sell the stock, though, because there's real earnings risk from Google search. Next is Amazon. I think Amazon's doing well with both its web services business and the Prime offerings. There's no sign whatsoever this retail share take is tapering off. Its ad business has become a favorite of the big ad buyers, along with YouTube and Google. Lots of the big non-tech titans run their websites on Amazon Web Services. I think Europe will be huge for them. Call me a buyer. How about Apple? Look, lots of people really abhor Apple here, and the myriad bears have been feasting this one, which is why it now trades at just 30 times earnings. But Apple has 1.3 billion users. I think they have the leverage to let others spend fortunes on AI to get into their universe. That more than makes up for the Sirigate fiasco, okay? What's not in the numbers here? The release of a foldable phone next year with big average selling price. Plus, I think most of the negatives are getting priced in, if not all of them. Kind of compelling, certainly compelling lower. Fourth, I worry about Meta. It's acting so well, but it's pure advertising play, and advertising is struggling in a slowdown. But what I am most worried about is Meta AI, its generative AI platform. It's got a lot of users, and it scrapes from its own sites, among others. Big leg up. We need to see if it can have the scale of Elon Musk Grok or OpenAI's ChatGPT. Both the ChatGPT and Grok are better, I think. Unless I try Meta AI all the time. Unless Mark Zuckerberg would like to come on Mad Money and show me how to use it better, I don't see that as attraction. It's a push. I'm plenty worried about Microsoft, too. Its Copilot really isn't as important or impressive as it's made out to be, and it's a total pain in the butt when they try to force it down your throat every time you turn on your PC. I think Mark Benioff was right when he knocked Copilot as the new Clippy. It'd be one thing if Microsoft could make the estimates, but they've missed 3 times now. That's why the stock's been such a dog. It could stay a dog if it misses again. I don't detect the urgency you need to have when you've missed 3 times. 6, we saw NVIDIA up close and personal last week, and I was actually blown away. I believe in the earnings. In fact, I think the AI infrastructure spending will only get stronger when they roll out new chips next year. Cheap. Now, I am concerned about this death cross thing, a pattern where the 50-day moving average slices through the 200-day, signaling a real breakdown. I wouldn't normally mind, but there's so many double inverse NVIDIA ETFs and zero-day options. And those have the power to be the tail that wags the dog sometimes. That is worrisome. We need to see this thing break out of that whole death cross stuff. We can take it out of the equation. Finally, there's the one that everyone's been dumping on, and that's Tesla. I think that people are misunderstanding the power of Tesla, the tech company. At these prices, Tesla, the car company, could have sales that were cut in half, and I don't know how much lower it would go. So as analyst coverage grows more positive after a year of negativity, it's notable that only Amazon and NVIDIA have truly positive setups. The rest, time will tell. But all these magnificent companies have one thing in common. Their stocks actually truly do get cheaper as they go lower. And that's more than I can say for many others that have held up well during this exceedingly difficult period. Like I said, there's always bull market summer. I promise I'll find just for you right here in Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.